Like most, you were too busy to save any tax throughout the financial year, and you are already at the end of this financial year. However, there is still time to save tax in last 5 days of this financial year, that is from 31st of March till 5th of April. Let me explain how. I am Prashant, and I want to help you invest wisely and save tax smartly. 31st of March. Most of us are paid by this date, and you have two things after that. You have more money to invest, and you have your payslip from month of March, which shows your taxable pay for that particular financial year.
You do not have to wait for your P60 to know your taxable salary. All you have to do is find the taxable salary in your March salary slip. If you have done overtime, you may receive a second salary slip. Add the taxable pays in both. Add up any other sources of income you have to get your figure of taxable income of that year.
Once you know your taxable income by 31st of March, you still have 5 days till 5th of April to save tax. Let me show you how. But hang on, let's first understand the tax bands of this financial year. Understanding the tax bands will help you understand our objective to save tax in last 5 days. And the objective is very simple. If you are a basic rate taxpayer, you should try and bring down your salary near your personal allowance, that is 12.5 thousand pounds. If you are a higher rate taxpayer, you should try and bring down your taxable salary near 50,000 pounds to avoid paying 40% tax above it. Taxable pay between 100 and 125,000 pounds is punished with a 60% tax. If your taxable income falls in that category, you should try and bring down your taxable pay near 100,000 pounds. How?
Workplace pension. It's too late to enter into workplace pension scheme at this stage of the month to save tax for this year. But if you anticipate a similar taxable salary in the next year, it's the best time to enroll for the workplace pension. Bonus sacrifice. This is a most efficient way to bring down your taxable salary and at the same time boost your pension, because in addition to the bonus amount, your employer contributes the national insurance due on your bonus into your pension. Most companies offer a bonus in March, and you are given options to sacrifice it into your pension. Unfortunately, in most companies, you have to declare your option by the end of February. So, if you have been a little more prudent, you could have sacrificed your bonus into your pension this year. Never mind, this is a tip for the next year. Self invested personal pension. As the name suggests, it is a pension which is contributed and managed by yourself. While investing in SIP, you have to bear in mind two things. Annual allowance. If you are a workplace pension member, work out how much you have contributed there. Your annual pension allowance is £40,000 and it includes your contribution, employer's contribution, tax saved due to the contributions. When you contribute to SIP, it will count towards your annual allowance. Lifetime pension allowance. One should be careful while contributing to pension not to cross the lifetime pension allowance, which is £1,073,000. Keep track of your annual contributions to the pension, and once you start nearing this amount, you may have to continue contributing to the workplace pension to maintain the benefit, but you should stop contributing to the SIP. Let's see how the SIP works. You can invest in ISA account only after paying tax on your income. On the other hand, even if you are investing in the SIP after paying tax, the SIP provider claims 20% of tax from the HMRC and invests it into your SIP. If you are a higher rate taxpayer, you can claim the remaining tax via your self-assessment. At the time of withdrawal, there is no tax on any amount you take out from the ISA. With SIP, 25% of the pot can be withdrawn without paying any tax, while for the rest 75%, you will pay tax according to your tax band at the time of withdrawal.
That's how SIP works. Let me explain it to you with an example.
Let's assume your taxable pay was £60,000. This means you are £10,000 above the threshold of basic taxpayer rate of 20%. Therefore, you will pay 40% tax on these £10,000 and will take home £6,000. Now, if you invest £10,000 into SIP, your SIP provider claims £2,000 and add up to your pension. And through self-assessment, you can claim another £2,000 from HMRC. Now let's assume your taxable pay was £110,000. As we have seen earlier, taxable pay between 100 and £125,000 is taxed at 60%. So for these £10,000 above the threshold of £100,000, you'll be paying 6,000 in tax and taking home only £4,000, unless you invest £10,000 into SIP, where the SIP provider claims £2,000 from HMRC, boosting your pension to £12,000, and you claim the rest of the £4,000 you paid in tax from HMRC through your self-assessment. That is all about SIP. Annual allowance for pension is £40,000 and you can carry forward allowances of the last 3 years. Utilize your pension allowance to save tax through SIP. If buy-to-let is your additional source of income, you may execute pending repairs in your buy-to-let in these 5 days and potentially save 20 to 60% tax on that expenditure amount.
That's it, folks. I hope this little video helps you save some tax in last 5 days of this financial year. Invest wisely and live happily. Take care.